to Lior Times. I am your global business correspondent, and tonight I am bringing you a story that almost no major financial channel is willing to explain in plain language. There is a hidden risk in the upcoming SpaceX IPO that could quietly damage millions of investor portfolios around the world, including in India, the Gulf, Europe, and the United States. The numbers behind this story are shocking. The mechanics are perfectly legal, and once you understand what is happening, you will look at index funds, retirement accounts, and IPO investing in a completely new way. Stay with me, because in the next 8 minutes, I will give you the truth that most brokers, most fund managers, and most YouTube finance influencers are simply not telling you. Let me start with the basics. SpaceX, the rocket company owned by Elon Musk, filed its initial public offering paperwork with the United States Securities and Exchange Commission on April 1st, 2026. Musk is now reportedly targeting a $2 trillion offering for the company, which would make it the single largest IPO in human history. To put $2 trillion in perspective, that is larger than the entire GDP of Italy, larger than the entire GDP of Brazil, larger than the combined market value of dozens of major companies. SpaceX would instantly become one of the most valuable companies on planet Earth. But here is the first shock. SpaceX is being valued at approximately 110 to 125 times its annual sales. Now, in stock market language, this is called a price to sales ratio. In healthy investing, technology companies typically trade at 5 to 15 times sales. Premium high growth companies might trade at 20 or 30 times sales. Even Tesla, at the peak of its bubble in 2021, traded at around 30 times sales. SpaceX at 110 to 125 times sales is in territory that has historically only been seen at the very peak of speculative manias like the dot-com bubble of the year 2000. This is not normal valuation. This is not even aggressive valuation. This is bubble territory. Now, here is where the story turns from interesting to genuinely shocking. Just days before SpaceX filed its IPO paperwork, the Nasdaq Stock Exchange announced new rules quietly changing how it includes new stocks in its Nasdaq 100 index. Now, why does this matter? The Nasdaq 100 is one of the most heavily tracked stock indexes in the world. Trillions of dollars in retirement accounts, mutual funds, exchange-traded funds, and pension portfolios are passively invested in funds that simply mirror the Nasdaq 100. When a stock enters this index, every single one of these passive funds is forced to buy that stock in proportion to its market weight. They have no choice. They are bound by their own fund mandates. Under the old Nasdaq rules, a newly listed stock had to wait a long period before being included in the Nasdaq 100. The new rules, conveniently announced just weeks before SpaceX's filing, allow significantly faster inclusion of large IPOs into the index. The mathematical result is straightforward. The moment SpaceX lists publicly, hundreds of billions of dollars of passive investor money around the world will be forced to buy SpaceX stock at whatever inflated price the market is paying at that moment. Whether you personally believe SpaceX is worth $2 trillion or not, your retirement fund or your index ETF could be quietly stuffing your portfolio with this stock. Let me explain why this matters in concrete numbers. If you are an Indian investor holding a global Nasdaq tracker ETF through a platform like INDmoney, Vested, Stockal, or any international brokerage, you are exposed. If you are a Gulf-based investor with international equity allocations, you are exposed. If you are a European investor with a Nasdaq-linked product, you are exposed. If you are an American with a 401k retirement account that includes any Nasdaq 100 fund, you are absolutely exposed. Millions of investors worldwide who never personally analyze SpaceX's fundamentals will become forced shareholders the moment this IPO lists, simply because of how passive index investing mechanically works. Now, let me share another angle that almost no major channel has properly explained. Elon Musk has spent the last 2 years deliberately and systematically increasing SpaceX's private valuation. In 2023, the company was valued around $180 billion. By December 2024, it had jumped to roughly $350 billion. In February 2026, a corporate merger between SpaceX and Musk-led startup XAI valued the combined entity at $1.25 trillion. Then within weeks, IPO discussions reportedly pushed valuation talk to $1.75 trillion, then to $2 trillion. This is not organic price discovery. This is sequential valuation engineering by a small group of insiders before they bring the company to public retail investors. Now, here is the deeper question every investor must ask. Why does Elon Musk want to take SpaceX public at the most inflated valuation in its history? The answer is uncomfortable but important. Musk and other early investors, including venture capital firms, sovereign wealth funds, and private equity houses, have already captured most of the value creation that happened privately over the past 20 years. SpaceX went from a small rocket startup to a $1.25 trillion company entirely in private markets. Public investors were never invited to participate in that journey. Now, at the very top of the valuation curve, public investors are being invited to provide what financial professionals call exit liquidity. Your money goes in, insider money comes out. That is the basic structure of every overvalued IPO in history. This is not just a SpaceX problem. The same forced inclusion mechanics could affect upcoming IPOs of OpenAI, Anthropic, Stripe, and Cerebras Systems. Goldman Sachs has officially forecasted approximately 100 IPOs in 2026, raising around $160 billion. But the bank also lowered its estimate from 120 deals because of valuation concerns. The 2026 IPO window is described by professional researchers as the most concentrated in over a decade, with very wide quality dispersion. Translation. Some of these IPOs will be genuinely good investments. Many of them will be valuation traps designed primarily to enrich early insiders. History is full of warnings. In 2024, an Indian-flavored example played out painfully. The Ibotta IPO listed at $88 in April 2024 quickly climbed and then collapsed. Investors discovered that key client contracts mentioned in the prospectus were actually at-will contracts that could be canceled anytime. The hype carried the stock up. The truth dragged it down. Lawsuits followed. Retail investors lost money. The same script could repeat with any 2026 IPO if investors fail to read prospectuses carefully or fail to understand what is really inside their index funds. So what is the practical action plan for a serious investor watching this video? First, before any major 2026 IPO, including SpaceX, OpenAI, or Anthropic actually lists, audit your existing portfolio. Find out exactly which funds you own. Read the fund fact sheet. Identify whether the fund has a mandate that automatically includes new high-cap IPOs. Most retail investors have no idea what is sitting inside their own portfolios. Second, never confuse brand strength with valuation strength. SpaceX is genuinely a remarkable company. Its rockets work, its satellite business is real, its technology is real, but a remarkable company at an unreasonable price is still a bad investment. Third, limit IPO exposure. Every credible advisor in India, the Gulf, and the West agrees that IPO exposure should be 5 to 10% of a portfolio at maximum, never more. Fourth, monitor post-listing performance carefully. Some of the worst losses in IPO history have happened in the 3 to 6 months after listing, not on day one. Now, let me share the most underreported angle of this entire story. Indian retail investors are particularly vulnerable to this trap because of the rapid growth of platforms that allow direct U.S. stock investing. Lakhs of Indian investors have opened international brokerage accounts in the past 3 years. Many of them invest passively, choosing simple Nasdaq trackers because they were told it is a safe long-term play. Most have never read the fund's full mandate. Most have no idea what Nasdaq rule changes mean. Most will only realize they own SpaceX, OpenAI, or Anthropic after the fact when the loss is already in their statement. This is not financial conspiracy. This is just the basic mechanics of modern index investing colliding with one of the most aggressive valuation engineering events in market history. The bottom line for every investor watching this is the following. The 2026 IPO wave is coming fast. Some of these listings will become legendary winners. Many of them will become cautionary tales. The one investing principle that will protect you across every cycle is simple. Understand what you own, read what you sign, know how your fund actually works, diversify ruthlessly, and never let the excitement of a famous brand override the discipline of valuation. SpaceX may eventually become a great long-term investment, but buying it at $2 trillion on day one of its IPO simply because your index fund forces you to is not investing. It is being used. That is all for this edition of Lior Times. If this analysis opened your eyes to a risk you did not know about, please subscribe to our channel and hit the bell icon. Share this video with anyone who has international stock exposure or holds Nasdaq-linked funds, because they need to hear this before the IPO lists. In the comments below, tell me one thing. Will you participate in the SpaceX IPO if it comes, or will you stay out? Your views shape our future coverage. Thank you for watching. Stay sharp, stay informed. This is Lior Times, your window into the global business world, from India to the world.